In recent weeks, we've heard several Fed representatives suggest that they are on the cusp of tapering the asset purchases that began as unlimited quantitative easing in March of 2020. Unfortunately, the last big economic data point we saw, non-farm payroll, gave us a strong suggestion that the economy is slowing, while inflation remains stubbornly high. Well, this obviously puts the Fed in an uncomfortable bind in choosing between supporting the slowing economy with continued QE or fighting inflation by removing the stimulus. Now, the shape of the U.S. yield curve is also signaling some indecision, as 2-year yields versus 10-year yields has traded in a pretty tight range between 1.17 and 0.97 since the beginning of July. Now, if a trader believes that the Fed will abandon plans of tapering and that this could spur inflation concerns and that could cause 2s versus 10s to steepen, a trader could sell the CME Micro Treasury 2-year yield contract and buy the Micro Treasury 10-year yield contract at a current spread price of 1.12 and then target the early June level of 1.50. That trade would make 38 basis points or $380 per one lot. Now, if a trader believes that the recent run of disappointing economic data is signaling a coming recession and that the yield curve could flatten out from here, a trader could buy the 2-year micro and sell the 10-year micro at that same spread price of 1.12 and target the summer of 2020 range around 0.60. That trade would make 52 ticks or $520 per one lot.